Welcome, everybody. We'll get started in just a moment's time. Thanks for your patience. All right, hopefully folks can see my screen now. Let's go ahead and kick things off. Looks like my screen is being shared. So am I. So Raj, if you're with us, we can get started.
Good morning, I'm here. Or good afternoon, sorry. I'm here, yes.
All right, sounds good. And let's begin. Welcome, everyone. We will kick things off right away. Today's presentation, navigating turbulence and volatility in your portfolio. Really important topic. A lot of folks are interested in it. US stock markets in 2025 have experienced pretty significant volatility, influenced by major geopolitical events, economic policies, as well as shifting investor sentiment. So, no matter where you are in your financial journey, it's a good idea for investors of all stripes to map out a plan. It helps you to feel confident as an investor and to make informed decisions about your money. So let's go ahead and get started. First, let's get the introductions out of the way. I'm Josh Brockwell, Investment Communications Director here at Azad. I'm responsible for all things marketing and also spearhead our shareholder advocacy program. With me today is Raj Mahmood. Raj started a career in finance in 2005 and has gained extensive knowledge in financial planning through his work at various firms in the DC metro area. He holds the Certified Financial Planner certification, as well as the Chartered Retirement Planning Counselor designation. His passion is helping people get on the right track to achieve their financial goals. Welcome, Raj. For those who may need a refresher, here's a quick look at who we are. For over 25 years now, Azad has been helping high-income professionals build their wealth in accordance with Islamic values. Today, we manage around $1.6 billion for more than 1,000 families across the United States. What makes us unlike many other financial firms out there is the quality and nature of our advice. It's centered around you and your families, driven by a higher purpose and designed to help give you peace of mind, knowing that your financial life is on track. And as a reminder, we're a full service financial planning advisory firm. Here's an overview of the services that we provide on your screen now, from investment planning to tax and charitable planning to halal financial services. We have positioned ourselves as the leading provider of halal financial services in the United States. With that, let's jump into our content for today. Okay, we're all here because volatility has reared its ugly head in recent months, sparking a little bit of panic among some. This graph on your screen right now provides a visual representation of how market volatility, as measured by the VIX, has changed over time. It's going to highlight that volatility is not constant and can spike dramatically in response to market shocks. And let me get the definition out of the way. In essence, the VIX is a measure of how much the market expects to change in the near term, often reflecting investor fear. It's sometimes even referred to as Wall Street's fear gauge. Basically, though, the VIX measures market expectation of near-term volatility. So that line graph on your screen right now shows the historical trend of the VIX over a period of several years. The y-axis, the vertical line to the left of your screen, represents the value of the VIX, which is a measure of the stock market's expectation of future volatility. Higher values generally indicate greater expected volatility or fear, while lower values suggest lower expected volatility and more market complacency. The x-axis, the horizontal line across the screen, represents the time period, in this case spanning from approximately mid-2020 through early 2025. So you'll see that blue line that represents the VIX value over time. It shows significant fluctuations, even just over the last few years, indicating periods of both high and low volatility. The graph is going to show you several sharp spikes, including the initial COVID-19 pandemic market crash in 2020. While the VIX fluctuates, it tends to revert to a more moderate level over time, but that is not the case right now. So the question is, how did we get here? Well, early 2025, to just turn back the tape a little bit, could be characterized as market turmoil amid trade conflicts. Pretty much everybody here already knows this. The year began with heightened market instability due to escalating trade tensions, to put it mildly. On April 2nd, President Donald Trump announced sweeping tariffs on goods from China, Canada, Mexico, among other countries. That led to a sharp global market downturn. The S&P 500, the NASDAQ, the Dow Jones Industrial Average all suffered significant losses, marking the worst market decline since that 2020 crash we just talked about. This period of uncertainty was exacerbated by retaliatory measures from affected countries and concerns over inflation and recession risks. Then just last week, markets rebounded following a temporary rollback of tariffs between the US and China. This de-escalation was seen as a best-case scenario by many analysts, and it reignited investor optimism. So the Dow Jones Industrial Average surged over 1,000 points, and tech stocks, particularly in artificial intelligence and semiconductors, led the rally. The VIX, that fear gauge we just talked about, which had hit a peak of 60 at one point in April due to tariff fears, traded below 20 last week for the first time since March. Now, Raj, over to you for some context.
All right. Thank you, Josh. Hopefully everybody can hear me okay.
Coming in loud and clear.
All right. Now, some people might feel unsure about investing in the stock market because it is riskier than keeping your money at home, keeping it in the bank, keeping it under your mattress. And that's completely understandable. Remember, investing involves risk, and no one likes the idea of potentially losing money to a bad investment or market fluctuations. So why do people invest at all? Well, the biggest reason is to keep up with inflation, right? Higher prices, rising cost of goods, money that's not growing, it reduces your spending power. So you need to find a way to keep up with inflation. And while there is potential for losses with investments, there's also possibility that you can see significant gains. A large part of investing is about figuring out how to properly balance that risk and reward relationship and which management strategy makes the most sense for you. And that's where I can help. I help clients tackle these thorny issues all the time. Also, watching financial markets go up and down can be nerve-wracking. But keep in mind that periods of market turmoil are normal and they're expected. That's why it's important to take a long view with investing and not let the short-term market volatility distract you from your long-term financial goals, like retirement, wealth building, kids' education, etc. Staying invested for the long haul puts you in a good position to reach these goals. Again, the most important advice we give our clients is to stay invested, even when times are turbulent. Investors forget that the cost they must pay for potential higher long-term returns is short-term market volatility, like the kind we've seen here lately. They think they can get in and out of the market without any consequences. And this is a very dangerous misconception. When you get out of the market, you will most likely need more time and your investments will need to work even harder for you than if you had stayed invested throughout the market volatility. So don't try to time the market. No one knows the perfect time to get in and out. What a lot of investors get wrong is that equities accumulate most of their gains over just a few trading days. If you miss these trading days, you will be significantly behind. We know just by looking at the screen here that missing a handful of the best days over a longer time period drastically reduces the average annual return you could gain by simply holding on to your investments during the market sell-offs. Avoiding the market downs may mean missing out on the ups as well. 78% of the stock market's best days have occurred during a bear market or during the first 2 months of a bull market. And if you missed the market's 10 best days over the past 30 years, your returns would be cut in half. And missing the best 30 days would reduce your returns by 83%. So what's the lesson here? It's time in the markets rather than timing the markets that will help you grow your wealth. I work with many prospects who come to us after they've panicked, sold out, and gotten out of the market. And I can't tell you how difficult it is to get them back in and then make up for what they've lost. I find that more often than not, the reason they got out in the first place is because they couldn't follow their investment plans. So work with your advisor, be honest about your risk tolerance, and create a plan and a strategy that you'll be able to stick to when the sky is falling. Next, and the point about staying invested applies to really bad markets as well. While it's true they can hurt, they are, however, normal. And we have history to back this up. Just look at the slide on your screen that goes back all the way to the Great Depression through the year 2022. The last year we saw a bear market in the S&P 500. A bear market is defined as a decline of 20% or more from a market recent highs, which is what we flirted with earlier this year as well. While declines have varied in intensity and frequency, they have been regular events. As history has shown us, the financial markets have rebounded from these market shocks, posting stronger returns over the long term. So instead of viewing market corrections as a bad thing, be prepared for them. Remember, the time to fix your roof isn't during a storm. The time to fix it is well in advance. The time to prepare is well in advance. This means checking in with your advisor to make sure that your investment plan reflects your risk tolerance and your goals. If you've experienced any major life changes, you recently got married or had a divorce or a newborn, job change, maybe you're approaching retirement, business isn't doing so well, any changes that you're going through, you need to let us know so we can make any adjustments to your investment plan that we need to. Knowing that you're prepared in advance for the next market slide will hopefully give you the confidence to stick to your plan. Next, a big part of navigating volatility relates to diversification. And this is where you divide up your money across different types of investments or asset classes to help spread your risk of investing. You may know the saying, don't put all your eggs in one basket. And that's the idea here behind diversification. Now, it might sound like a basic strategy, however, it is one of the most powerful ones. By investing in a mix of asset classes like small size companies, mid, large, as well as halal fixed income. If a certain asset class isn't doing well, that means the other asset class in your portfolio might be able to offset some of those losses. So diversification can help limit your exposure to risk of just one investment. Think about it this way, if you only invested in one stock of one company, you risk losing your entire investment if that company goes under. Now, the important note here is diversification can help minimize your risk, but it cannot eliminate it altogether. Just as diversification doesn't guarantee gains, it also doesn't completely shield you from losses. There's no such thing as a perfectly safe investment. And if anyone tries to tell you otherwise, be wary and run the other way. And of course, ensure that your diversified portfolio is still aligned with halal investing guidelines by working with a qualified Azad advisor to walk you through that process. And diversification means that you cannot simply just invest in the S&P 500. Many of us have forgotten that the total return over a 10-year period starting in December 2009 for large caps, as represented by the S&P 500, was a negative 9.1%. That's right, negative return for the entire 10-year period. Annualized was negative 0.95. However, investors with a diversified portfolio, they experience positive returns during that same time. This is because other asset classes like small, mid, international, they perform much better. The S&P Mid Cap Index posted an annualized total return of 6.3%, and small cap did about 6.4 during that time. Even the S&P 500 as an equal weight did about 5.1% over that same time. That's 6% higher. The lesson here again is diversification across different classes has proven itself to work over a long-term period. Look at your portfolio. If you are heavily concentrated in a few technology-based, Magnificent Seven types of investments, you probably are not set up to navigate the future market turbulence. Next, staying on the topic of diversification, this slide demonstrates that no asset class stays on the top or the bottom for long. This is a look at all the Azad portfolios and their performance ranked each year going back 10 years. And as you can see, certain asset classes do well in certain years and not so well in the others. That's why at Azad, we provide our investors with separately managed accounts that replicate a diverse group of asset classes, from REITs to international, small, mid, large cap stocks. And then we combine the equity portion and offset it with halal fixed income for an allocation strategy that is in accordance with your risk tolerance. True diversification involves investing in different types of assets. This helps to reduce the overall risk and volatility of your investments. The key to diversification is to invest in assets that have low or negative correlation to each other. This means that when one asset class is underperforming, the other one might be outperforming, which helps to balance your overall portfolio. And then you rebalance your portfolio. Rebalancing means bringing your investments back into alignment with your objectives and your comfort with risk. Josh, I'll turn it back over to you to touch on a couple of our investment strategies.
Thank you, Raj. Appreciate the guidance for navigating some of this turbulence we're seeing right now. And yeah, you're right. You've mentioned the importance of halal fixed income, along with its importance as a diversifier and a way to mitigate volatility. So let me quickly remind folks about the Azad Wise Capital Fund. To properly diversify across different assets, you do need to incorporate fixed income into your portfolio so that you can help control the overall risk level of that portfolio. However, as many of us know, the majority of fixed income out there is riba-based or interest-based. We launched this fund in 2010 to fix that. So the Azad Wise Capital Fund is similar to a short-term bond fund in that its holdings have a maturity of 1 to 3 years at most. It aims to deliver income while limiting the volatility associated with longer-term bond strategies, and it's focused on capital preservation. But it does this in an interesting way. It's through high-quality, diversified investments like Sukuk or Islamic bank deposits or halal trade finance, actually a combination of all of those, as well as some dividend-paying stocks that are halal screened. It's managed by a 3-person management team at Federated Hermes. Predominantly, they have an extensive amount of experience in this area, and they're a multi-billion-dollar firm. In fact, the fund's track record shows its importance during times of volatility, not unlike those times we're talking about right now. It's performed very similarly to its benchmark, the ICE Bank of America 1 to 3 year benchmark, which is used to analyze the performance of many short-term fixed income investments. For more information about this fund, you can visit our website, azadasset.com, to read its prospectus, and it's also available for purchase, incidentally, at your broker or brokerage firm of choice. Let me also mention, as we talk about the Azad Wise Capital Fund, your time horizon and risk tolerance are going to help determine how much of it you actually own. It will help you determine the appropriate mix of investments more broadly in your portfolio. Time horizon is simply the amount of time that you're planning on staying invested. It's going to typically depend on your age, investment strategies, and financial goals. These are things you talk to folks like Raj about. People who won't need to tap into their investments for a while, for instance, those who are a ways out from retirement, would generally have a longer time horizon than, say, people who are investing money for down payment on a home that's a few years down the road. If you already have a time horizon in mind, another question you should ask yourself is how much risk you're willing to take. Are you willing to have a lot of risk in your investment portfolio? In other words, what's your risk tolerance? Risk tolerance varies from person to person, and it's important to understand your personal level of comfort when it comes to investing your money. We can work with you, specifically folks like Raj can work with you to determine a risk profile that fits for you. From there, we can create an all-weather strategy to help navigate volatility more comfortably for you. I'll also add, just so folks are aware, we talk about it a lot, but really can't talk about it enough. In times like these, the value of having a financial advisor really shines through. But regardless of the market, several studies show that the money you spend on financial planning really pays off. In fact, these studies place the value of financial advice at anywhere from around 1.5 to 5% per year in excess returns. This year, Russell Investments put the potential value of advisors at 4.87%. You see that on your screen now. The largest component of that total value comes from behavioral coaching, stuff that Raj does. In other words, helping you to stick to a long-term investment strategy, not overreact to market volatility, not chase performance, and avoid making costly mistakes. Back to you, Raj, for some concluding remarks on navigating market turbulence and volatility.
Thank you, Josh. So a lot of clients ask me, what's 2025 look like? What can we expect in the future? Again, a lot of it is going to depend on trade policies, right? As well as economic indicators and geopolitical development. So there could be some more volatility ahead, but regardless, there are going to be challenges. However, there is potential for markets to reclaim previous highs if these economic conditions stabilize and trade relations improve. But regardless of what is affecting the market, there are a few key behaviors that you as clients, myself including, that we need to implement so we can have success in our investing. Number one, invest consistently, right? Regardless of what's happening, contribute regularly, monthly, quarterly, regardless of market conditions. Take advantage of the dollar cost averaging into your portfolios. Number two, stay the course. Stick to your investment strategy, especially during market downturns. Avoid panic selling, avoid going in and out of the market. Those things can really hinder your portfolio performance. Think long-term. Focus on 10-year time horizons. Don't look at it or don't worry about it on a daily basis or what's the monthly return or what's the quarterly return. Think long-term, let compounding do its job and work for you over that time period. Diversify wisely. Spread your investments across different asset classes. We talked about this already. Don't be too heavily concentrated in one sector, one class, or one stock. Rebalance periodically. Reallocate your portfolio annually, semi-annually, or whenever the target risk range gets out. The rebalancing concept automatically implements you sell high, you buy low. Number six, minimize tax burdens, take advantage of tax advantaged accounts, IRAs, 401ks. These are concepts that allow you to grow your wealth efficiently. Avoid market timing. No one can consistently predict the market. No one can time the highs and lows, and time in the market beats timing the market. Try your best to tune out the noise. I know it's hard. It's hard to avoid headlines. It's hard to avoid social media, but focus on the fundamentals, right? Don't worry about what's the hottest trend or, what can we do to mitigate losses or how can we make more money? Fear of missing out. Those are all the noises that most people hear from social media and headlines. Automate good habits. Like I said, set up automatic contributions. You reinvest dividends. This removes the emotion out of the process. And last thing, just educate yourself. And what you're going to find during the education process is the ones that stay the course, have a plan, have a strategy, and follow through with it, end up being the most successful investors. And Josh, I will turn it back to you. I think now we're ready for some questions.
Yeah, thank you. I will just also say before we get to that, if we can all kind of internalize and take to heart and put into practice what you just said, I think we'll all be a lot better off. And when you've got the right allocation and financial plan made in consultation with an advisor, I think folks can be in a better position to confidently navigate whatever the market's going to throw at us. Let me also say, by the way, that if folks have questions about how to do anything that we've talked about today, enlist the help of a financial advisor like Raj, who can go over what we've covered in more detail and help you hopefully invest confidently for your future. And speaking of questions, we're going to take those from our attendees starting right now. So you'll use that Q&A box in the control panel of the Zoom app to ask your questions. Let's get to the first one. Just a second here. The first one, Raj, has to do with this Sell America trade that we've heard a lot about lately, especially in the wake of the Moody's downgrade of the United States credit rating. A lot of folks are concerned about yields on long-term treasuries and what increased yields might have to say about stock prices longer term, if that increases borrowing costs and that affects the economy more broadly. So I guess maybe to summarize what's being asked, maybe to continue on your points here at the end that you just made, what action steps could someone take right now to navigate the market volatility that we've seen?
Yeah, that's a great question, Josh. So two action steps that I would highly recommend all clients take right now. Number one, assess your risk tolerance. So, schedule a meeting with your advisor, and during that meeting, action item number one is to go through your risk assessment, go through your risk tolerance. Because a lot of times, what's the headlines, what's in the news, that's one thing, but in looking at your portfolio, we have to assess what's your tolerance, how okay are you with the volatility. So going through that risk assessment really allows clients to focus on, am I okay with this type of decline in my portfolio? If the market pulled back 10% and my portfolio goes down 5%, am I okay with that? And what does that look like in terms of dollar value? So step one, during that meeting, go through your risk assessment. Step two, and I think this is the most important, is to review your financial plan. If you're an Azad client, you should already have a financial plan. If you don't, schedule a financial planning meeting right away. A financial plan will allow you to really focus on your goals, not what's going on in the market and not what's going on in the news. It'll focus on, when do you want to retire? How much do you need to retire on? What's the likelihood of you accomplishing that goal? When should you start Social Security? Am I setting aside enough money for my kids' education? Travel, donation, charitable goals that you have. So the financial planning process will focus on your goals, and based on the allocation and your risk assessment, we'll be able to put together a strategy that gets you to achieve these goals in the long term. So those are the two most important action steps, action items that I personally would do working with an advisor, is to review my financial plan, make sure that everything looks good, I've identified my goals, and then go through my risk assessment to see what upside potential I'm okay with and what's the downside risk I'm taking in my portfolio.
Perfect. Thank you. Another question we see here, is it a good time to invest cash I have sitting in the bank?
That's a question I get pretty often, Josh. So if if you're sitting on a lot of cash, and again, keep in mind if this is cash above and beyond your emergency. So step one, you have to have enough cash to cover typically 6 to 9 months worth of expenses, household expenses. So if this is cash that you have above and beyond your emergency fund, then we again have to have a meeting and define that we are investing this one for the long term, right? We're not investing. If you're not investing for the long term, then it's not a good time because investing for 6 months, 9 months, short term, that's not the game that you want to play. So if you're investing for the long term, if this is cash that can help you accomplish those goals that you have in your financial plan, maybe accomplish them faster, sooner, then yes, it is a great time to invest that cash. Now, couple of ways that you can deploy this cash. You can do it through dollar cost averaging, right? We talked about this, how periodically investing, monthly investing, quarterly, weekly, it allows you to dollar cost average into the market and take advantage of different prices into the stock market. And two, if you want to set up a separate strategy, we set up an account, we set up a strategy that is earmarked for this specific account that has a specific goal or target. And again, we can design an allocation based on your risk tolerance for this specific cash. So there's two ways we can go about it. But number one, it has to be for the long term. This can't be your emergency, and it has to be cash you put towards accomplishing your goals. Yeah.
All right, perfect. The next question has to do with exposure to international stocks, or specifically how someone could increase their exposure to international stocks in various categories. I'm assuming this is in light of some of the outsized performance we've seen elsewhere. Obviously, not looking for people to chase performance, but
Mhm.
some of the benchmarks out there, like the ACWI US and others, have looked pretty good when you exclude the United States of late.
Yeah.
So maybe just a comment about international investing in general, how it fits into maybe a broader, diversely allocated portfolio.
Yeah, we've definitely seen international do much better than domestic this year. But again, we wanna make sure that we are not performance chasing, right? We can do that. We've seen people do that with small caps in the past. Lately here, we've seen people do that with large cap growth stocks, the Magnificent Seven. So this is time for internet. Like every portfolio or every asset class has its time to shine, right? We've seen that, and even the Azad quilt chart shows you that, right? Right now, it happens to be international's time to shine. Do you want to do you want to add exposure to that? Again, we have to just assess the risk tolerance. As long as you're comfortable with the risk that comes with it, and it doesn't go outside of the allocation that we project long term to be successful, then yeah, we can take a look at it. But ideally, you stay within the allocation that has the right exposure to all asset classes, not just international, but large cap, mid, small, fixed income, and as long as we're okay with that, then yeah, absolutely.
Okay, perfect. And yeah, there are some comments in here about concerns over debt and deficits in light of the recent passage of the bill in the House, the one big beautiful bill. Obviously, that needs to be reconciled with the Senate version, whatever happens there. And clearly, that downgrade that happened from Moody's recently wasn't the first time that's occurred. I mean, I can remember this conversation back in 2011 with S&P when they did it the first time. The United States lost its solid gold AAA credit rating. There were
Mhm.
concerns about the ability of the United States to maintain its fiscal house or to get its fiscal house in order. and
Yeah.
long-term viability. But I mean, obviously, we've seen these headlines before. Happened again with
Yeah.
Fitch 11, 12
hmm
years later. I don't know if you want to comment on some of the cyclicality and just kind of staying the course.
Yeah, I mean, we've seen this before, and the reality is, if we just look back, Josh, over the last, I would say 7 years, right? You go back to like 2018, for example, and I still remember the 2018. I mean, the market was doing great the first 3 quarters, and then there was some noise that really caused the last quarter of 2018, where the S&P dropped by below 2,500 and ended the year negative. And there was a lot of concern about market. They had the yield inverse, right? The 10-year and 2-year kind of inverted, and they say that's a sign of we're heading towards a recession. So, but I still remember the 2019 followed with record highs, right? We hit record highs in 2019, right after that volatility at the end of 2018. And then 2020 came around, and we all know what happened in 2020. It was the COVID, right? The COVID global shutdown. I mean, the markets were in free fall, and it just seemed like it was going to be another, Great Depression. Who knew when we were going to recover? But shortly thereafter, we started rallying, and the market hit record highs again in 2021. And then 2022, we had the interest rate hikes, right? The Federal Reserve started raising interest rates to fight inflation. And again, we had double-digit drops in 2022. And there was a lot of questions about, well, what do we do now? How can we navigate this? And ultimately, the ones that stayed the course, they came out bigger and better in 2023 and 2024. So it's something different every time. But the reality is, as long as we stay invested, we stay the course, we stay within our risk tolerance, we've always seen the markets, our accounts, the portfolios rebound faster and bigger than where they were before. So never forget that. That's sometimes we feel like, okay, well, 2008 was so long ago, or 2001 was so long ago, and it was. But 2018, 2020, 2022, that was just recent, and we came through that, and we did better than before. And inshallah, no matter what happens, I think the markets are resilient. I think the markets, especially if you own good quality companies like we own in our portfolios, right? We don't own companies with a lot of debt. Obviously, we don't own companies that don't pass the halal and Sharia compliance and screening. We buy good quality companies that have been around for a long time, have a good track record, have good leadership, and have great long-term growth potential and success. So as long as your portfolio comprises of those types of investments, then they will be resilient, regardless of what the market brings.
And on that very hopeful and optimistic note, I think it's probably a good time to wrap up the Q&A portion of the program today. I will just, in the interest of time, show you these last few slides very quickly. We do want to take the opportunity to inform you about our on-demand webinars. A few of those, the recent ones on your screen right now. Please be on the lookout for more information about future live webinars. And obviously, you can always catch the recaps at azadasset.com. That's going to wrap up today's presentation. I'd like to thank all of you who took the time to be here with us live today. If you'd like more information about Azad Asset Management, anything else we've talked about here today, please do reach out to us. The email address is hello@azadasset.com. Be sure to follow us on social media as well. The handle for our Facebook and YouTube accounts is @AzadFunds. You can find us on LinkedIn under our full name, Azad Asset Management. Thank you, Raj, for being here. Thanks, everybody else. Appreciate it. Have a great rest of your day.
Thank you, everybody.